Welcome to our 8th installment of Real Estate and Credit today. My name is Kevin Lewis, the owner of Premisien Inc., which is the parent company of Premisien Credit Counseling. My partner, Abby Bridgeford from Genuine Property Solutions Real Estate, is taking care of some personal business. She's been on the mend. I'm not going to put all of her business out there, but just want to send healing energies to her. And I'm going to let you guys know we're still going to have an enriching session, although the star of the show won't be here. I'm going to do my best to carry the load here and do the heavy lifting. So welcome again. Today in the credit section, we're going to switch from, we've been talking about personal credit up until this point. Today, we're going to transition into business credit. And if you use the personal credit and the business credit in conjunction, your economic power is going to be exponentially increased. So today, we're going to have some fun. We're going to talk about personal credit. I've got my friends in the room. I've got my friends who are online. For those of you who are online, stay tuned because we've got some things coming up that we'll make you aware of, some other seminars that Abby and I are going to be doing together, and we'll make mention of some of the marketing efforts that we'll put into effect. But let's jump into business credit today. We're going to talk business credit today, if you don't mind. Before I get into business credit and how to build business credit and the first phase, and today we're going to talk about the first phase of business credit. But first, I want to give you an overview of what business credit is and why it's necessary and how you get set up. And how I want to start the conversation, Shauna, is I want to start the conversation by talking about the 4 C's of business bankability. And as you guys know, I am really expressive with my hands, but I try to be as engaging as possible. So I like to poll the audience, free questions sometimes I pose questions. So I'm going to poll the audience a little bit right now and ask you guys, when you're running a business, there are 3 ways that you can inject capital into the business. So you guys help me out. And listen, if you answer a question and it's not right, I won't say you're wrong. I'll do everything in my power to make you right, as you guys know. So Shavonda, what's one of the ways that you can inject capital in your business? Your business needs some money. How can you put money into the business? One of the ways. Give me just one way.
One way to put money.
One way to put money in your business.
By saving that money.
Saving the money. We call that bootstrapping, or putting the money into your business from your own pocket. So an owner or the owners can inject capital into your business by pulling it out of their own pockets, or bringing money from the business that the business has already, revenue that the business has already generated, putting it back into the business. That is one way. No way is better or worse than any other, and you can use all of them in conjunction. But let me tell you one of the caveats or one of the issues with using your own money. So Shavonda, let's say you have a business. Say you have a business.
Okay.
No, say it.
Oh.
So you have a business, right?
Uh-huh.
Let's say you are fiscally responsible in your business and you understand that you've got to put money away every month or every time you get revenue for emergencies.
Okay.
Because emergencies will happen in your personal life, emergencies will happen in your business life. It's a guarantee. It's a guarantee. So let's say you put in your business, every month you put $10,000 aside. Now, you are wealthy, so that $10,000 is no big deal for you.
Okay.
Every month, you put $10,000 a month for savings. And this is to use for business emergencies. And then the building that you're in has one said emergency. So for 10 months, you've been putting $10,000 aside, which means that's $100,000. And I got the math right on that, right? It's $100,000, right? So you have a building emergency that requires you to use all $100,000 of that money. I saw your face.
Yeah.
I saw your face. You guys, did that make you sad?
Yeah.
Why did it make you sad?
Because I have no money left.
You got no money. So for those of you guys who can't see, Aaron just patted Shavonda on the shoulder. So you have no more money left. Well, let's say you get a $100,000 opportunity in month 11.
Okay.
You can't take advantage of that 100,000. Let's say somebody offers you another building. They need you to put a down payment of $100,000 on it, but it can generate $1 million worth in revenue. You can't take advantage of that opportunity because you just spent all $100,000 of the savings. It's going to take you another 10 months at minimum to recoup that $100,000, right? So all of the opportunities that come along in that 10-month span, you can't take advantage of because you spent your savings. But easy way to put money into your business. Okay, good stuff. Amber, give me another way you can inject capital into your business. You can put money into your business. Said it can come out of your pocket or come out of your business record. What else?
You can go on Shark Tank and ask Damon John for $100,000 for 10%.
You can ask Damon. So beautifully said. Such a wise. This young lady, wise beyond her years.
Thank you.
So you can go on Shark Tank and ask Damon John to give you $100,000, and he will ask for 10% equity stake in your business. Great. Injection of capital. So now you still have that $100,000 because you're still saving it, right? So now that $100,000 is still in the bank, but now Damon John is giving you $100,000. Caveat, you got it right away. Caveat though is
10%.
Damon John is going to require 10%, which means he has 10% controlling interest, which means depending on the deal, he may be able to determine the packaging of your products. He may be able to determine location, right? He may be able to determine control of how you manage the business, but you got the money. So you have to surrender some type of control. Again, not better or worse than savings, just another issue that you have to be concerned about. Rashawn, you've heard about bootstrapping or using reinvestment capital. You've heard of investing, that's called equity financing, by the way, what you just described is called equity financing. What's the third one? Loans. That's called debt finance. So we talk about bootstrapping, we talk about equity financing. Now we're going to talk about debt financing. Debt financing simply means someone's going to lend you some money. They're going to expect you to pay back that money plus interest, right? Many times it's going to be a bank or a creditor or a lender of some sort. Sometimes you can get personal loans, but for the most part, they're going to be loans, and you're going to be required to pay back at least the money that you borrow over a specified period of time and potentially interest. Now, we're talking business credit. And when we talk business credit, we are talking about debt finance, not talking about equity or bootstraps. We're talking debt finance. All of which, again, are powerful ways to inject capital in your business. All businesses will need one or a combination of these methods at some point. If you are attempting to expand, grow, or start, you're going to need an injection of capital. So let's focus on the debt financing method of injecting capital. When you go to a bank, there are these things called the 4 C's of business bankability. These are the 4 things that a lender is going to look for in your business to determine whether or not they're going to extend a loan to you. There's the potential for a 5th, and I'll talk about that in just a moment, why that's important in today's environment. But let's talk about the 4 C's that you always. The first one is character. Character, Shana, is the credit worthiness of the business and the business owners or the business owners. The probability that they are going to repay the loan. And they are going to look at the business's payday score and the business owner or owner's FICO score. What's payday score? That's your business credit score. It's called a payday score, and it's actually a paydex rating. So in personal, it's a FICO score. In business, it's a paydex rating. In business, you are rated A through F, A being the best, F being the worst. And everything in between is what it is. So you will have the business will have a paydex rating, the owner or owners will have FICO score. And by the way, we're going to talk about this a little bit later, so this will come up later. But your paydex rating can be attached to your business independent of the owner's social security number. All right. So they're going to look at your credit reports to determine whether or not you are good character, whether your business is good capital. And if your business has a paydex rating that is good enough, then they may not have to look at the owner's FICO score. And we're gonna talk about how to get your paydex rating to a place over the next few months. We're gonna talk about how to get your paydex rating to a place so that you don't have to rely on the FICO score. All right, the second C is capital. That is how much money you bootstrap. So Siobhan, going back to your example, the bank wants to see that you put money in, because here's the deal, Siobhan. I'm not gonna lend you money if you haven't put your own money into the business, right? If you don't believe in you, why should I believe? So the business is going to look at the capital that you've already injected and the potential to inject more capital. And they're going to look at two documents. There are three financial statements in business: income statement, balance sheet, statement of cash flows. In the second C, they're going to look at your balance sheet and your income statement to determine if you have put enough capital into your business. The balance sheet, they're going to be looking at specifically your assets and retained earnings. Your income statement, they're going to be looking at your net profit. Now, at some point, I might do a full conversation about the three financial statements. Today, I want to talk about building business credit. So I'm not going to go into depth about how to read these and how to use these. But I just want to tell you, they're going to be looking at the balance sheet and the income statement. So if you are a business owner, you're going to want to make sure you pay as much attention as possible to these documents. All right, the third C, collateral. By the way, no one C is more important than the other. They use all four in conjunction. The third C is collateral. How many assets, or what is the value of the assets that the business has and or the business owners have? And they're going to look at those assets on the balance sheet and the owner's personal financial statement. On the balance sheet of the business, they're going to look at your assets. On the personal financial statement, they're also going to look at your assets and may determine that you need to do a personal guarantee where you might have to put, this is where you've seen business owners sometimes put their houses up as collateral for a loan for their business. All right, so balance sheet, personal financial statements. Now, what you guys can't see all the way down here, but we'll get into, is capacity. Capacity, the fourth C, and that is the cash flow of the business, the profitability of the business. They want to know that you are going to pay this loan back. And when the bank looks at this, they're going to be looking at your income statement and your statement of cash flow. On the income statement, they're going to be looking at your net profit, your revenue minus all of your expenses. And then on the cash flow statement, they're going to be looking at your daily cash flows and how you're using your daily cash flows compared to the expenses that you have every year. All right, those are the four C's. So it would behoove you to know what's on your business credit report, what's on your personal credit report. Fix any issues that you have on either one. It would behoove you to make sure you're looking at your balance sheet and you want to put as many assets in your business name as possible. So Rashawn, this is where getting off the personal, when Jay-Z says, I'm not a businessman, I'm a businessman. When Jay-Z says that, he's saying, I am putting as many assets as I can in the name of my business, not my personal name. So I move my houses out of my personal name, I move my cars out of my personal name, the clothes that I wear, all in the business name, because the more assets the business has, the better your balance sheet is going to look to a lender. You want to look at your personal financial statement and show how many assets you have here. And then again, you want to make sure your, oh, by the way, net profit, you want to increase revenues, decrease expenses as much as possible. All right, I have, the fifth C, and the fifth C is always a potential C, and that is conditions, market conditions. You guys experienced the fifth C starting in 2020 on up to 2022. And that was the pandemic. The pandemic changed drastically the conditions of lending. Lenders tightened their belts. They weren't giving out a lot of money. That is why the interest rates today are so high, because we're coming off the pandemic and the government has to recoup some of the expenses. Banks need to recoup some of the expenses and some of the losses that they took in the pandemic. So market conditions are such that this fifth C will have an impact on whether they're gonna lend to or not. All right, if we can go to the next slide, if you don't mind, thank you so much. All right, so, what is true business credit? You are building business credit if you are securing credit using your EIN, which is your employer identification number, not your personal credit. You'll know it's true business credit because if you're filling out a business credit application and it asks for your EIN first on the application, then your social security number, it's business credit. If it's flipped, if they ask for your social security number first, then your business EIN number, it is now personal credit. Now you are personally guaranteed. And don't be fooled, and sometimes don't be too concerned if they're asking for social security numbers and date of birth on business credit applications, because there's been a new law passed in the last 3 years called the Patriot Act, and that Patriot Act requires a lot of lenders to ask for the names, addresses, social security numbers, and date of birth of potential lendees, because they're trying to thwart terrorist activity and the financing of it. So they're trying to verify that the creditee, the person who's being money being lent to, they're trying to verify that that person is indeed who they say they are. So just because you put your social and your date of birth on the application doesn't mean you're personally guaranteed. When you're filling out the application, ask the lender, do I need to personally guarantee? All right. You can get business credit without a personal guarantee, and I will show you that. And what this says down here is what I just talked about, which is that Patriot Act. All right, we can go. All right. What's your name? Henry? I'm Kevin Henry.
All right.
I'm wonderful, Henry. Do you believe me? Believe I'm wonderful? Okay. Not a lie, baby. Not a lie. I wouldn't tell you something that's what I'm wonderful. So Henry, I'm going to tell you about the advantages, some of the advantages of business credit over personal credit. One of those is how they look at credit limits versus credit age. In business credit, Henry, they don't care how long you have credit. A lender doesn't care as how long you have credit. If you started your business in November of 2022 and go for a loan today, your business is less than 1 year old. Lender doesn't care as much about that as they care about the credit limits that you have.
Our personal credit.
Both your business credit limits and your personal credit. The first thing we want to concentrate on is your business credit limit. So we want to establish if you the day that you start a business, you should start building business credit. By the way, Amber, let me say this to you. I want to emphasize this point. It is next to impossible to get credit in an emergency situation, personal or business. And I can't tell you how frustrating it is. The clients come to me. I've got clients who I told to start their business credit 5 years ago. They were like, I don't want to pay you. I don't want to do that. I'm a fledgling business, so I don't really need business credit. Today came, they need $100,000. I talked to a client 2 days ago. Client said to me, not a client. Let me just be clear. Person's not a client. They are someone who was a potential client who I talked to 2 years ago, but says to me, I have a contract for my business. The government is sent me an agreement for a contract for $146,000, but I need $50,000 worth of equipment, and I can't get an equipment loan. And I said, now, do you remember the conversation we had 2 years ago where I said, start building your business credit because you can't get it when you need it? So for the last 4 months, she's been applying and been getting denied because she has no credit history. She has no business credit limits. So she's getting denied. She's going to get denied. And do you know, Harry, she still didn't sign up for my help? That's right. I'm gonna hear from her 2 years from now, so I'm not worried about it. She's missing opportunities because you gotta start. So as soon as you start your business, start building business credit. And the higher business credit limits you have, the more business credit you'll get. In personal credit, credit age is something. In business credit, it's not. Payment history. That's a big deal. That's a big difference. So Siobhan, let me give you an example of how payment history hurts you. Let's say you have a credit card and you miss a payment on that credit card. It's going to go on your credit report. Your score is going to go down 30 to 40 points, possibly 50, depending on what it's on. It's going to take you 24 months, 2 years, 24 months to get those 30 to 40 points back. And all you can do is wait. Or you can ask the company to do a goodwill removal, but it's very difficult. And I talked about that when I was talking about personal credit. Bottom line is, it's going to take you 24 months. You missed a payment or you made a late payment. It's going to take you 24 months to get those 30 to 40 points back. But let's talk about business credit. Let's say you have what's called a net 30 account. Net 30 account, Emma, means they're going to give you these products or services. They're going to give you an invoice. You have 30 days to pay that invoice. Let's say you pay that invoice at 45 days. So you paid it 2 weeks later, right? Your score on your business credit side, your business credit rating is going to drop. But in order to get that credit rating to go right back, so let's say it drops 20 points, the equivalent of 20 points, right? In order to get those 20 points back, remember you were 15 days late? The next net 30 account, just pay it 15 days early. So instead of paying at the 30-day mark, Henry, pay it on the 15-day mark. You'll get those points right back. So in essence, your score could drop on the business side and go right back up in the same cycle. Not the 24 months. It could take you 2 weeks. All right?
That's not personal.
That's not on the person. Not on the person. Only on the business. Only on the business. Okay. What age can you start your own personal credit profile independent of your parents? Amber, this question is for you because
I was gonna say 18.
you should say that. Say it loud. Say it.
18.
18. Say it one more time.
18.
Okay. In this country, you can start a personal credit profile independent of your parents at age 18. In business credit, you can start business credit as soon as you have a social security number. That means for many of us, birth, some of us that migrated to this country, whenever we get the social security number. That means you can start building business credit age 9, age 5, age 2. Now, not political. Not political. Many people start their children's businesses when they're young. Start building their business credit so that when they get older, they can use the business credit instead of their personal credit. And I'm going to show you how powerful that is when I get down here and talk about this, which I'm about to do right now. So you can start as soon as you have a social security number. This is a big deal. I so love talking about this in business credit. I so love talking about this because personal credit gives you this much power. Business credit gives you this much power. Here's one of the ways that it gives you this much power in how mortgages versus business loan. So let's say you find a house. That house costs $100,000. You buy it with a traditional mortgage. Let's say that mortgage is a 30-year fixed mortgage. The $100,000, the way mortgages work is they are front-loaded with the interest. That means you're going to pay for the first 15 years of this mortgage. Most of the money you're going to pay is just the interest on the mortgage. About year 15, when you start to pay into the principal, really into the principal. On a 30-year mortgage, that $100,000 house is going to cost you about $380,000 total. If you stay in it for 30 years, you stay in that mortgage for 30 years. Business loans, same house, same $100,000. Business loans are backloaded. which means the interest is on the back end and is on top of the principal. So that $100,000 house is gonna cost you let's say the business loan, the terms are 10%. You're gonna pay $110,000, 10,000 in interest plus the $100,000. So the total payback is gonna be $110,000. 380, 110,000. You save $280,000 by buying that same property, same exact house, but buying that house as a business loan instead of a personal loan or a mortgage. You're gonna save about $280,000, which means you can put Amazon $3,000, Chiffon $3,000, your daughter $3,000. You can put my daughter $3,000, which I appreciate. So that's one of the ways you're gonna save money. Now, business loans typically, or commercial loans, typically always have higher interest rates. But again, remember, you're paying on the top and not injected into the loan. This is where this really gets some power. And this is good. This is very good. This is very good. This is great. Good, great. Good, great. But together, you can use it. Student loans versus business loans. If you get a student loan, you guys all know, if you get a federal student loan, that student loan will follow you to, and in some instances, through debt. And I'll talk about through debt in just a second. So you get, let's say, you got $100,000 worth of student loans. No, let's say 250,000. You go to a private institution. All right, you got $250,000 worth of student loans. And you have a life insurance policy that is a $500,000 life insurance policy. Well, when you pass, the federal government can put a lien on the $250,000 that you owe them, which means you only pass along $250,000, not the full $500,000, minus whatever fees, right? So by getting a student loan, you could be potentially eroding the wealth that you're trying to pass on to your children or to other people, right? But you can get a business loan instead of a student loan. Same school, business loan. You started, so we go back to here. You started building business credit when you were 10. 8 years have passed. You now have a solid business credit profile. You walk into a bank, you ask them for a business loan. They say, what is the loan for? Educational expenses. They say, justify that. You say, I'm going to go to Princeton University for marketing. I'm going to use that marketing for my business. Now, by the way, you have to run a legitimate business. You need to be running a legitimate business. It needs to be generating revenue. It needs to have expenses, and you need to be filing taxes because the banks are going to ask for tax return. But if you are running a legitimate business, you started at 10. Selling lemonade, right? You started at 10. You built it into a lemonade company, you built it into a lemonade chain, and then you build it into a national lemonade conglomerate, right? When you turn 18, you're going to go to the bank and say, I'm going to take out, that lemonade company is going to take out a $100,000 loan for me. I'm going to use it to go to University of Princeton or Princeton University. I think those are my release. Princeton University, and I'm going for marketing so that I can increase the value and the marketability of that business. Now, here's the good news. Heaven forbid, like the example before, heaven forbid you pass away. When you pass away, you're going to dissolve that business, and all the debts that went along with that business are dissolved. So if you passed away, that $100,000 that you borrowed is no longer a debt. Good. All right. Enough. It's good stuff. We can go to the next.
There's a question.
Oh, there's a question.
So say you have personal credit and you have that $100,000 debt. Does that, and you die, heaven forbid, does that go to your children or something?
It doesn't go to your children unless your children are tied up in a personal guarantee for that loan. Or again, the only way that really impacts your children is if your children were the beneficiaries of that life insurance policy. And that life insurance policy puts a lien on, a student loan puts a lien on that life insurance policy. But the only way your children can be liable is if they were tied, if they were on the application as co-borrowers.
Say co-sign.
Co-signs, correct. Which we have, known to have happened. All right, answer your question? Cool. All right. Business credit, it's a relationship to personal credit. Many major lenders require personal guarantees. So in some instances, you cannot get out of doing a personal guarantee. You go to do a business loan, business line of credit, or a credit card, they may ask you to personally guarantee it, which means you're going to put your social security number, your personal credit up as a guarantee. And if you default on the business loan, they're going to put a collections or a charge off or a non-payment mark on your personal credit. Higher personal credit scores get better approval odds and better rates. So the higher your personal score, the likelier you are, or the more likely you are to get approved for business credit. And at better rates. So if you have a 650, you are probably going to get a better rate than if you have a 550. And better approval odds. All right. Higher personal limits get higher business lending limits. So Henry, if you have personal credit cards, the higher the limits on those personal credit cards, the higher the limits will be on your business credit card. For example, if you have amassed $25,000 worth of limits on your personal credit cards collectively, then it's usually 4 to 5 times higher. So you're typically going to get $100,000 to $125,000 worth of limits in business credit. So I encourage you every 6 months to increase the limits on all of your credit cards. Don't get new credit cards. Don't get new ones. Just the existing one. Increase the limits every 6 months because the higher the credit limits are. They don't care about utilization. Siobhan, they don't care about utilization. Meaning you can have $25,000 worth of limits and owe $25,000 on those $25,000 worth of limits. The business credits don't care about that. They just care that you have the $25,000. Okay, and then the last thing is the higher the profile on the personal side, the higher the profile on the business side. For example, if you have I don't like to put people's names out there, but if you have an Amex card on the personal side, it is easier to get an Amex card on the business side than if you have a Credit One on the personal side. It's going to be difficult for you to get it. It's going to be more difficult for you to get an Amex on the business side if all you have is a Credit One. Yes.
I have a question from the virtual audience.
Talk to me, virtual.
They are asking the point regarding the point of increasing your credit every 6 months. Will they increase your limits if you are not using it?
The likelihood is no. So that's a great question. That goes back into what I talked about in the personal, but the likelihood is no. You want to use your credit cards. Please, people, use your credit cards. Small amounts. Small amounts. Let me talk to the virtual audience.
I gotta talk over here.
Oh, I'm sorry. I have a virtual audience here and a virtual audience here. My fault. I'm going to talk to this one. So you want to use all of your credit cards, but only use small amounts. But let me tell you a technique that I use. I use my credit cards as debit cards. What do I mean by that? First of all, I talked about this before. I'll talk about it again really briefly, and then I'll jump into I'll finish the business credit. So debit cards are a very dangerous financial vehicle because they don't come with a lot of protections, and they rarely, if ever, I've never seen one to be honest, they rarely come with lifestyle points. Let me talk about protections. So let's say you have a debit card. You have a card that's connected to your checking account, and somebody gets that debit card number and they use it to buy $1,000 worth of products, right? You will be liable. The bank will launch an investigation, and in many instances, they will shut access to your checking account down. Now, if you got revenue, particularly you business owners, if you got revenue going into that checking account, that means you have no access to that revenue until they finish the investigation. And I have seen investigations can take up to 21 days before they release access to your money, which means for 3 weeks, you have no access to the money that's coming in from your business, right? That's very dangerous. The other issue is no points. Most credit cards come with rewards points, flights, hotels, rental cars, materials, products, goods, whatever. So credit cards are better. So how I use credit cards as debit cards is, let's say I go into Lowe's and I buy $50 worth of stuff. I buy $50 worth of stuff on my credit card. The next day I go pay $50. I make sure that I have $50 in my checking account. I use the credit card to buy that $50 worth of products. And then the very next day, I pay it off. So now I have the protections and I have the points. Let me go back to the protections. On credit cards, let's say somebody stole your credit card and they charge that $1,000 worth of products or services, let's say products. The credit card company typically only holds you liable for the first $50 of that $1,000, which means you can still use, let's say your credit card had a $1,000 limit, somebody charged the whole $1,000 up, you launch an investigation. The credit card company typically says you're only liable for $50. So you have $950 still to use on your credit card, pending the investigation. Once the investigation ends, they determine that you are not responsible for that $1,000. They'll even give you the $50 back, which means you never lose access to more than $950 at a time, more than $50 at a time, right? That's the protection. And again, the points that come along with your credit card, way better. Like I said, I've never seen a debit card that gives you reward points. So I encourage you guys, use your credit cards, pay them as if they were debit cards, meaning use them today, but only use what you have in your checking account and then pay the bill the next day or 2 days later. All right. I think I answered that question. We can go to the. All right. Now we're getting into business credit and the phases. Now, there are many people in this industry who are teaching and talking about building business credit, and they have a process. We all use the same process. They may chop it up differently, but we all use the same process. Today, I'm going to finish our conversation by talking about what our phase. So Premisien Credit Counseling, we use a 5-phase process. The first phase for us is business legitimacy, and today I'm going to talk about that, and that's where I'll close the conversation. So it's business legitimacy, then vendor accounts, then retail accounts, then credit cards, then major lending. People, please don't skip over these. A lot of people have this in place, and then they go here. They apply for a business credit card. Typically, when you open a business bank account, the bank may ask you, do you want to apply for a credit card? Don't do it. Say no, because you'll get higher limits and you'll get better lending or opportunities if you've gone through the other phases first. If you've already done this, no worries, just go back, start off where you are supposed to begin. All right, business legitimacy, vendor accounts, retail accounts, credit cards, major limits. So let's talk about business legitimacy. Business legitimacy means making yourself appealing to a creditor. And how you make yourself appealing to a creditor is definitely. In addition to that, though, you want to have some things in place. First thing you want to have is bank accounts, business bank accounts. And I suggest, this is just a suggestion, I suggest you have 3 business bank accounts. A bank account at a major bank, a bank account, a checking account at a major bank, a savings account at a credit union, and a checking account at a community bank. A community bank is any bank that is only in the neighborhood or the state that you live in. It doesn't go outside of state boundaries. Okay? Major bank, use that to deposit all of the revenue from your business, 100% of the revenue. Take the first 25% of the money that you deposited in the major bank, put it in your pocket. That's pay yourself first. Take the second 25%, put it in a savings account and a credit union. Remember I talked about those emergencies, those business emergencies that will happen? The second 25% go into the credit union savings account, business savings account, so that when those emergencies come up, you only use the money that's in there. The third 25%, you put it in your checking account at the community bank. That's what you use to pay the expenses of your business, all the expenses. And then the fourth 25% will stay in the major bank, and that's what we use to pay taxes. Okay. Once you got the business bank account set up, get a website. By the way, these things are in order on purpose because one feeds the next. The bank accounts you want to have in place because before you pay for a website, whether you're doing it yourself or you're having somebody do it for you, before you pay for your website, you want to have your bank account open because you want to pay for that website out of which account, Sean? Well, which business account? Which business account would you pay for your website out of? The community bank, because this is your expense account. This is your savings. This is your taxes. So expenses, your website is an expense. So open those three, and then you pay for the website out of the community bank. By the way, Rashawn, what that does for you is that lets you know what your budget is. When you go to a web designer, they're gonna ask you what's your budget. I can't stand that question because I don't know. I don't know what I should have for a budget. I don't do this. I can tell you what a credit budget should be because I do this. So I don't know. But here's the deal. If you have $1,000 in this account, then you know this website can't cost you more than $1,000. You definitely cannot go into this account. All right? So build a website next. After the website typically comes with a branded email. By the way, let me go back to the website. Please, for the listening audience, please, those of you guys who think that running your business off of social media is the only place that you need to have a digital presence, a creditor this is the first place a creditor is going to look to see if you're a legitimate business. And what they're looking to see is one, that you have a website, doesn't have to be elaborate, but they're looking to see that you have a website, but they're also looking to see that the website is advertising the same business that you're applying for credit. Now, guys, I live in my community. I service my community. I don't discriminate, but I service my community. You guys with these businesses that are jack of all trades businesses. I registered my business and I sell jewelry, but I do real estate and I do flooring. When a bank that's trying to lend you $1,000 sees your website, you put on the website, I need $100,000 because I got a flooring contract over at Frankfurt and Market train station. And they say, but your website says you sell jewelry. You don't know what you do. I can't trust that you're gonna pay us our money. Build a website. The website site should be consistent with what you do. If you are running 3 different businesses, you need to have 3 different websites. All right, branded email. Branded email means an email that signifies your business specifically. Putting the name of your business in front of @Gmail is not a branded email. It needs to be something at yourcompany.com, not something at gmail.com. That's important. I have seen applications be thrown out for something as trivial as the name Premisien@gmail.com. Get a phone number separate from your cell phone and be able to list that phone number with 411.com. 411.com is the largest repository for business phone numbers. So the bank is going to look for your website first. They want to look for consistency. They're gonna look at the email address that you submitted the application, on the application, to see that it's branded. And then they're gonna look at 411.com to see that you're listed. If you're not listed, many times they throw the application out because they wanna make sure that they can contact you if you do not pay their bill. Then office space. Office space. Now, I should have put these in order and maybe I'll do that, I'll go back and do that. But the order, the pecking order for office spaces is a brick and mortar gives them more confidence than a virtual office. A virtual office gives them more confidence than a home office. So if you are building a business and you're gonna be in a brick and mortar, if you're a restaurant, you're fine. But if you are a type of business that can run out of your home, or you do not need front facing, you don't have to have, there's no customer facing functions in your company, then you might be able to do a virtual office. Now, the virtual office thing. There are two different virtual services. There's a virtual mailbox service and a virtual office service. Virtual mailbox service, virtual office service. A virtual mailbox is like a post office box. It'll give you a street address, but it is a mailing service. You pay for the service every month. You can have packages and mail sent to this virtual office or virtual mailbox, and they will forward that mail to any place that you tell them to. Banks do not like those. They look at those as post office boxes. It's better for you to have a virtual office. Virtual office may still provide the same service. They may do a mail forwarding service, but they give you the ability, you might know them I call them virtual offices, you might know them as co-working spaces or share spaces. That means you can go in and actually rent office space in there for a specified period of time. You might be able to rent it by the hour, by the day, by the month, by the year, or what have you. But a virtual office is much better than a home office. But virtual mailboxes, please stop using those. Don't use those. It's post office boxes. Whether you get a virtual office or not, make sure you get a unique address. If you renting space, there are a lot of spaces out here that rent virtual offices and they rent suites in them, but they allow several different businesses to use those suites. So let's say you are at 1500 Chestnut Street, Suite 100. Make sure you're the only person that has Suite 100. If you're sharing it with 6 other businesses, then tell them to list you as 600 Suite 100A, so that you are different from the rest of them. If you don't want to pay for them, that's fine. You can run it out of your home. Home-based businesses are much less likely to get approved for funding than these other two. The reason the pecking order is the way it is, brick and mortar, then virtual office, then home office, is because the banks deem a brick and mortar harder to walk away from than a virtual office. And a virtual office harder to walk away from than a home office. If for whatever reason the bills add up and you can't run the business, it is harder to walk away from a brick and mortar. All right, bring this thing to a close. The next thing is, once you've done all this, get a DUNS number. Please do not do this before you've done all this, because all of this information goes into the DUNS number application. The DUNS number is what creditors will attach your credit profile to. If we were comparing it to cars or using a car as an analogy, the VIN number would be your EIN. The license plate number would be your DUNS number. You know, if you get pulled over by the police, they're going to call in your license plate number, not your VIN number. Same thing. They're going to attach your credit to your DUNS number, not your EIN number. Now, DUNS number is free. You get it from Dun & Bradstreet. Just go on their website, apply for a DUNS number. Dun & Brad, can't talk about it. Anyway, get a DUNS number. And then the last thing is to sign up for NAB. NAB is the business equivalent of Credit Karma. It helps you monitor your credit, your business credit progress. So sign up for an account. It is also free. And you can see your business credit rating over time using NAB, NAB.com. All right. Any room questions? Talked a lot. Any comments?
I don't,
You want to give it to me?
no, I'll sell it to you though. No, I'm not gonna sell it to you either. I'm not gonna get any money from it. But I sell it to you. Now, what I would like to know, if I take that property and use it as collateral, will that be a secured loan or will it just be flat?
It's what they call a collateralized loan. My company actually does those. 80/20 LTV, by the way. But yes, you can get a loan on that. So let me ask this question. What do you want the loan to do?
I want the loan to disappear on the house.
Yeah.
So
Yeah,
and get it to a point where it can be rented.
yep.
I live in the city. Why?
We got some information for you. Yeah, we got some information. But absolutely, that's called a collateralized loan. And like I said, Rashana has some resources. My company also does collateralized loans for investors. So
Are you familiar with One Main Street?
yes. Yes.
Are they legitimate?
You're asking, are they legitimate? I think the question is, are they predatory? I think that the better question is, are they predatory?
Okay, I can go with that.
So for legal reasons, I cannot say yes or no.
Okay.
What I can say is, I advise my clients not to use one.
Well, my cousin told me that 15, 20 years ago. And I went through that, and every time they would send something, I give it. But trying to move this project along, because it's been mine since 2016. But now I'm in a position where I can do something with it. And I wanted to get like maybe $6,000-7,000, and I thought Main Street being like that quick place to make decisions, that would be great to cook. I was denied the loan, and I got must be at least 10 calls from different other people. So I said, what they did was they took my application and they sold my information.
For sure. Again, legitimate business, but a big data collector. Big data collector. And let me take that one step further. Big data collector for our community. Our in bold, capital, and underline, right? And which is how some of the predatory lending products get into our community, right? So there are many companies, mine included, that do what you're asking is a collateralized loan. We take the equity that's in the property, we give you 80% of the value of that equity, and you can use that for rehab.
Now, if it's paid for, that help too.
Absolutely,
I don't have a mortgage.
absolutely. That's even better. That means straight equity. That's a beautiful thing. You'd be happy. Please don't let it go. Hold on to that property.
Well, you know, I tell people my mother worked hard at the house to leave me something. And she was here by herself, you know. Brothers and sisters were in another state down south. So I think she wanted to make sure I would never be homeless. I'd always have some place to stay because that's kind of. And I was going to sell it to my cousin for 40 or 60. There was squatters. She wanted the squatters out of there. I guess I don't have that's the ghost for the connection, you know, for somebody who with guns and thinking, wow, okay. So they finally moved out. So I've had it free and clear of trespassing since maybe January.
So you have some great value. Hold on to it as long as you possibly can. Because, and if you absolutely have to let go of it, please, I implore you, please let it go to someone in the family.
Okay, well, that's what I was just getting ready to mention. See if we gave me feedback on it. My mom, before she passed, had been in, the waiver program. That program sends out people to your home.
Home health.
She was in that for, I don't know how long. But what I know is that if there's ever a sale of the house, the Commonwealth of Pennsylvania, that every dime is included that home.
That waiver program, that's right.
So that's why, at this point, definitely no sale.
Don't sell. That's smart.
Okay, so
Perfect. Ladies and gentlemen, that is business legitimacy phase of business credit. We'll be here next month. The second Friday, we're here the second Friday of every month until December. Love to have conversations with you. I believe Abby will be back in September, stronger than ever.
second Friday.
Second Friday, 1 o'clock. I'll certainly be here second Friday, and we can talk more, and I'll talk more about vendor credit. Right? Till next time, thank you very much. Thank you.